Welcome to the debate. Welcome to breaking news to trading moves. Think about trying to jump onto a moving train while it is passing through a pitch black tunnel,
That sounds like a terrible idea.
right? I mean, you have absolutely no idea who is already on that train. You do not know if it is about to hit a brick wall. And the ticket price is, well, it's actively changing while you are in midair.
Yeah, it's chaotic.
Exactly. And that is exactly what you are doing when you execute a trade the moment the opening bell rings at 9:30 a.m. Today, we are debating the intense market dynamics that take place right at the market open. Is participating in this initial window a dangerous trap, or is it an essential strategy for active traders?
The classic 9:30 dilemma.
Patience is basically mandatory for long-term survival in the markets.
And I will argue that the opening bell represents concentrated, highly valuable institutional order flow. Avoiding it entirely means missing out on legitimate, data-driven momentum.
Well, the premise here is really about structural disadvantage. When the clock strikes 9:30 a.m., you see jumping prices, volume surges, flashing red and green lights on your screen. It practically screams at you to act.
It definitely triggers the FOMO, yeah.
Right, but that urgency is entirely manufactured. If you buy right at the open, you pay a penalty. I mean, you get the worst possible price, you suffer from wider bid-ask spreads, market makers actually pull their liquidity to protect themselves from early volatility, which leads to terrible slippage.
Well, they have to manage their risk. Sure, but the price you click is rarely the price you get filled at. And worse, that initial vertical spike on your chart, it is very rarely a sustainable trend. It is just emotional order flow or forced covering from trapped overnight short sellers hitting the panic button. Urgency is not an edge. It is a beginner's tax.
Okay, I completely disagree with calling it a beginner's tax. We have to look at what the open actually is mechanically, right? It is the purest moment of price discovery in the trading day.
Purist? That's a stretch.
It is. Think about all the information compressed into the overnight period. You have earnings reports, analyst upgrades, macroeconomic data releases, global news events. The moment the bell rings, the market has to price all of that new reality into the asset instantly.
But the mechanism for doing that is totally broken. It's fast, not broken. When a stock gaps higher and pushes aggressively, it isn't setting a trap. It is reflecting real institutional orders repositioning their portfolios based on hard data. You talk about market makers pulling liquidity. Sure, the spread widens slightly, but the sheer volume of institutional shares being traded absorbs it.
Wait, hold on. You are saying the real money is showing its hand, but you are assuming that pricing process is clean. It's not. It is chaotic and predatory. Let's break down how that tape actually moves. And look at how a market maker operates at 9:30 a.m.
Okay, let's hear it.
A market maker's job is to provide liquidity, meaning they are always willing to buy or sell shares. But they aren't charities, right? They manage risk. At the open, when overnight news hits, the market makers do not know where the stock will settle.
Which is why the spreads widen.
Exactly. What do their computer models do? They instantly widen the bid-ask spread to protect themselves from adverse selection. So instead of a stock being offered at $50.99, the spread might explode to $50.50 and $49.50.
Right, the spread widens to accommodate the sudden influx of orders. That is just basic market mechanics.
It is, but picture the retail trader sitting at home listening to this. If you are listening, you have almost certainly felt that pit in your stomach. You see the green line shoot up, your heart rate spikes, you click buy market, and instantly, within milliseconds, the stock reverses. Why?
Because they bought the top of an emotional move.
Because the algorithmic trading desks saw your market order coming, they front-run the panic. Because the spread was widened by the market maker, you do not get filled at the price you saw on the screen. You get filled at the absolute highest end of that spread.
Ouch, yeah. Slippage is real.
You instantly lose 50 cents a share to slippage before the trade even registers. They sweep the thin order book, create a fake vertical candle, and then sell their shares to you at the top. You just became liquidity for a computer program.
Look, you are describing the absolute worst-case scenario of an unprepared retail trader blindly clicking a mouse in a panic. Yes, algorithms exploit emotional trading, but algorithms do not create 10 million shares of volume out of thin air.
They don't have to. They just ride the wave of the retail panic.
No, that requires institutional backing. If an enterprise software company beats earnings estimates by 30% and gaps up, the algorithms might cause some micro-volatility in the first 60 seconds, but the sustained momentum over the first 15 minutes is driven by mutual funds and hedge funds accumulating a position.
But how can a human trader differentiate between algorithmic manipulation and institutional accumulation at 9:31 a.m.? By the time you realize it is real accumulation, the price has already run.
By preparing before the bell, you look at the pre-market volume, you look at the catalyst. It isn't a guessing game. The data is available.
Pre-market data is notoriously thin, though.
Not always. If the stock is trading 3 million shares in the pre-market, the algorithms cannot fake that level of participation. Real buyers are stepping in.
I don't buy that pre-market volume guarantees a clean open. Even with high pre-market volume, the actual bell triggers a unique kind of panic. Think about the psychology of overnight short sellers for a second.
Oh, the short squeeze.
Right. Let's say a trader short to stock on Tuesday afternoon. Wednesday morning, the company releases unexpected positive news. The stock gaps up 20% before the market opens. When that 9:30 a.m. bell rings, that short seller is trapped.
And they have to buy to cover.
Exactly. Their broker forces a margin call, or they panic and buy to cover their position. This creates a massive, violent upward spike. To an untrained eye, it looks like eager institutional buying, but it's just forced liquidation.
It still moves the price, though.
Yeah, but once that short squeeze ends, 5 minutes later, the stock plummets. If you are buying that spike, you are catching a falling piano.
Okay, but forced liquidation is still a real price mechanism. A short squeeze creates upward velocity. A professional momentum trader does not care if the buying is from an excited hedge fund or a terrified short seller.
You really don't think the source matters?
Velocity is velocity. If you know how to read the tape, that forced covering provides the cleanest, fastest move of the entire session. You capture the momentum, take your profit, and step aside before the reversal.
Let's talk about capturing that momentum then, because this is where the math completely falls apart. Walk me through the math here. Let's say your thesis is correct. A stock has great news, it opens and it prints a massive vertical green candle. You buy right at the top of that candle at 9:31 a.m. Where exactly are you placing your stop loss?
Well, if I'm trading the opening momentum, my stop loss is likely going to be the low of that opening minute candle, or perhaps the pre-market support level.
Exactly. And because you entered at the top of a vertical spike, your stop loss is now miles away from your entry price.
It's wider, yes.
It's not just wider. You are taking on a catastrophic amount of risk relative to your potential reward. A completely normal, healthy pullback, the kind that happens in almost every upward trend to test previous resistance, will suddenly feel incredibly dangerous because your entry was mathematically terrible.
Only if you don't adjust for it.
But most traders don't. You end up getting stopped out for a devastating loss, only to watch the stock eventually turn around and execute your original idea without you. You were right about the direction, but the execution at the open made it a losing trade.
The mistake in your math is assuming the position size remains identical to a standard trade. The edge in trading fast momentum doesn't lie in demanding a perfectly tight stop loss. It lies in dynamic position sizing.
Okay, explain how that fixes the math.
It's straightforward. If the volatility is higher at the open and your technical stop loss needs to be wider to survive a normal pullback, the adjustment is simple. You reduce your share size. You take half or a quarter of your normal position so that your total dollar risk remains exactly the same.
So you're just trading smaller.
Yes. By sizing down, you accommodate the wider stop required by the opening range. This allows you to participate in a stock that can continue higher all day without risking your entire account on a single dip.
But
let me just finish this thought.
the trader who refuses to adapt their sizing, who just sits there waiting endlessly for calmer price action, is going to repeatedly miss out on the cleanest moves of the day. Wait, if you're cutting your position size to a quarter of your normal size just to survive the volatility, your upside is now stunted.
Not necessarily.
It is. You are risking a massive percentage drop in the stock price just to capture what might only be a minor continuation. You are entering a market where the variables are entirely skewed against you. Good trading mandates entering where the downside is strictly controlled and the upside justifies the risk.
And I'm saying it does justify it.
Chasing a vertical candle inherently violates that mathematical rule because you are paying the maximum premium at the exact moment uncertainty is highest.
I'd argue the uncertainty actually drops during that vertical candle because the market is finally showing its hand. Before the bell, it's all theory. When the bell rings, it becomes reality.
A very messy reality.
Sure, but if a stock gaps up and immediately flushes downward, meaning it rapidly drops at the bell, the tape is telling you the overnight buyers are trapped. If it gaps up and drives forward, the tape is confirming the strength of the catalyst. You say the upside is stunted by a smaller position size, but in a true momentum environment, the reward is often much larger than anticipated. A stock with a fresh catalyst can run 50 or 100% in a single session.
Come on, that is the lottery ticket mentality. You are relying on outlier moves to justify a structurally flawed entry.
It's not a lottery ticket if you have a statistical edge based on the catalyst.
Let's look at the short side, which is equally treacherous. A trader sees a weak stock and decides to short it right after an opening flush. They are shorting right into a level where larger, better capitalized buyers might be stepping in to accumulate shares at a discount.
Which causes a violent bounce.
Right. The resulting bounce stops the trader out immediately. You cannot calculate a real risk-to-reward ratio when the bid-ask spreads are jumping by 50 cents every second.
Then let's focus on execution. How do you propose a trader handles a premier catalyst if they refuse to trade the open? If a company releases stellar earnings and the stock is poised to run all day, what does the disciplined trader actually do while they're sitting on their hands?
They aren't just sitting on their hands. They let the opening range develop. Experienced traders utilize specific observable metrics instead of guessing based on tape speed. They watch how the price interacts with key structural levels. For instance, they watch VWAP, the volume-weighted average price.
Let's define that for a second because I think we view its utility differently.
Sure. The VWAP is the average price a stock has traded at throughout the day based on both volume and price. It acts as a line in the sand for institutional algorithms to judge whether they are overpaying.
Right, it's a benchmark.
Exactly. Institutional algorithms are programmed to execute massive block orders, millions of shares, without disrupting the market price. How do they measure if they are doing a good job? They compare their average fill price to the VWAP. If a stock is trading way above VWAP, the algorithms will often pause buying, waiting for the price to revert to the mean so they do not overpay.
Which creates a pullback.
Exactly. If you are buying a vertical candle at 9:32 a.m., you are often buying exactly when the algorithmic buying shuts off. You are left holding the bag while the stock naturally drifts back down to the VWAP line.
Well, if you bought at the absolute top, sure.
That is why professionals wait. They let the price retest the VWAP. If it holds successfully above that level, proving that buyers are actually defending the new price, they enter with a tight stop just below that line, or they look for a failed spike that confirms sellers are in control. By waiting for these structures to form over the first 15 to 30 minutes, they identify a clear, tight stop level.
Identifying key levels like VWAP or pre-market highs is mandatory, yes. But identifying those levels and deciding what invalidates a setup must happen before the bell rings. That is part of a professional pre-market routine.
I agree with that part.
Right, so if a trader has done their homework, they already know exactly where they want to interact with a stock. If the bell rings and the stock immediately pushes through their predefined resistance level with strong relative volume, executing that trade in the second minute of the day isn't chasing, it is executing a heavily researched plan.
But executing a plan in an unstable environment is still dangerous.
The execution happens to occur during a fast move, but the logic was established in a calm environment hours prior. Waiting for a textbook retest that never materializes means you are letting your plan go unexecuted simply because the market moved faster than you preferred.
You are creating a loophole that justifies almost any early entry as long as someone claims they planned it.
It's not a loophole, it's preparation.
The reality of market microstructure is that those first few minutes are inherently unstable.
Unstable or just fast?
Structurally unstable. As we discussed earlier, The order book is thin because market makers widen their quotes. When the order book is thin, it does not take much volume to create a massive vertical candle. It creates an absolute illusion of strength.
But the volume validates it.
Sometimes it doesn't. A stock can gap up, drive forward for 3 minutes on thin liquidity, and then spend the next 6 hours bleeding out. If you wait out that initial frenzy, you allow the market makers to narrow the spreads. You allow the volume to confirm whether the continuation is real or just exhaustion. What do you actually lose by waiting? Missing a move costs you absolutely nothing in terms of your account balance.
Missing a move costs nothing in capital. I will give you that. But it carries a heavy opportunity cost over a long sample size. If your strategy relies on capturing volatility, and you consistently sit out the most volatile period of the day, your mathematical edge will degrade.
I completely disagree. The concept of letting others fight over the first price is crucial. You want the institutional algorithms, the desperate short sellers, and the emotional retail traders to clear out their conflicting orders. You let the dust settle so you can see the actual battlefield.
So you're just letting everyone else do the heavy lifting.
Yes. If you are entering at 9:32 a.m., you are, by definition, taking on slippage, spread variations, and trap potential before the market has provided any secondary confirmation.
Observing rather than reacting means you do not click the mouse just because the stock is flashing green. It means you do not succumb to the fear of missing out. But if the stock meets every single strict criterion you established before the bell, observing it hit your target, entry, and then refusing to take the trade because it's only 9:32 a.m. is a complete failure of execution.
I wouldn't call it a failure. It's self-preservation.
The professionals who specialize in momentum and price discovery are absolutely executing in those early minutes. They are paid to digest the compressed information faster than the broader market.
But the psychological toll of that environment is brutal. Let's be honest about human nature here. When a trader chases a vertical candle, gets stopped out due to poor risk-to-reward mechanics, and then watches the stock run without them, what happens next?
Usually, revenge trading.
Exactly. Revenge trading. They are angry, they feel cheated, and they start throwing capital at the screen trying to make it back. That is where the real damage to the account occurs. The initial loss might have been small, but the emotional cascade ruins their entire week.
I completely agree that the psychological damage of a poor early entry is profound. Committing capital without a logical stop or defined risk parameters is a critical error regardless of the time of day.
Right.
The discipline lies in knowing the exact difference between a planned momentum execution and an emotional reaction to a flashing screen.
That brings us to a clear area of agreement, I think. Whether you view the opening bell as an arena for precise momentum execution or a chaotic period best left to settle, the underlying requirement is structural discipline.
Absolutely.
Movement requires participation. The opening move is meticulously designed by market mechanics to make you feel rushed. It preys on human psychology. But urgency is not an edge. Waiting for a clear stop level keeps your position sizing mathematically sound and protects your core capital.
A reliable routine revolves around preparation. Identify your key levels before the bell. Decide exactly what action will confirm your thesis and what action will invalidate it. If the stock offers a clean entry, whether that happens in the second minute or the second hour, you take it with a defined stop.
Exactly.
If the price action never aligns with your risk-to-reward parameters, you simply let it go. The data compressed into the open provides the fuel for the entire session's movement, but you do not have to stand directly in the blast radius to capture the energy.
The market will always offer more trades, more sessions, and more opportunities. Your primary job is not to catch every single move, but to wait for situations where the risk is clearly defined, the reward is mathematically attractive, and your decision is driven by a tested plan rather than sudden emotion. Beginners often pay heavily for the thrill of the excitement. Professionals are compensated for their patience. It ultimately comes down to knowing your personal methodology, If you are going to operate in the opening minutes, you must accept the wider spreads, the slippage, and the necessity of rapid decision-making.
Yep, if you prefer calmer continuation patterns, you must accept that you will sometimes watch explosive moves happen without you. Both approaches require an absolute commitment to risk management.
Let's return to the analogy we started with. Imagine again that you are standing on the platform, watching that train barrel through the dark tunnel. You feel the adrenaline telling you to jump right now before it is too late. The real test of a professional isn't how fast they can leap into the dark. The real test is having the discipline to stand quietly in the chaos, knowing exactly where the train is heading, and waiting until it pulls safely into the station before you decide to buy a ticket.